Hi, this is Karen Lin. Welcome to Financial Accounting Week 4. In this week, we are discussing two chapters of materials. I'm going to start with Chapter 4, Adjusting Process. In the past chapters, we discussed how we analyze certain transactions and formalize them in a debit and credit format, which is our journal entry. So in this case, investors invested money in a company, we debit cash, credit common stock. And then we post this to our general ledger to summarize all these informations and prepare a trial balance to see whether we did things correctly. Before we can do the further step, which we prepare for financial statement, we need an extra process to review the data and make sure we have all the data making sense at the end of the accounting period. This process is called reviewing process. So the reviewing process will generate an adjustment entries to adjust anything that you see in your data that is not reasonable. When we talk about reasonable, when I say reasonable, I'll explain to you what that means. So mainly we are looking for these areas. First of all, are revenues and expenses recorded correctly? And second of all, did we make any mistakes? Um, Trying to understand, accountants do make mistakes. One important reason that they make mistakes is that they didn't understand or they sometimes forget about the ideas of recognizing revenues and expenses. So this is what we need to learn in this chapter, that companies recognize revenues and expenses not based on whether these revenues and expenses, or you thought they are revenue or expenses because cash is received or paid. Okay, so again, cash received or paid are not criteria to recognize revenues and expenses. So let's talk about some basic principles. When we recognize revenues, one main principle is that we want to recognize revenue when our service is performed. That means we want to make sure the revenue is earned when we recognize a revenue. So in a service company, revenue is considered to be earned at the time the service is performed. If the company is selling products, revenue is earned when the product leaves the company and has a positive possibility that is um, received by the other party who is buying the inventory, which is a separate question. So in our course, we are going to use the guitar lessons, which is a revenue, which is a service company. So we are only talking about service revenue. So here are some examples of revenue recognition. You can pause the video and ask yourself, so let's assume in the current accounting period, it is September 2019. Okay, so for accounting period, we mean we define a period where our accounting work is constrained to, which means we do not unlimitedly including all the transactions for all the time in one report. We always select a period. It could be a month, it could be a quarter, it could be a year. So let's say it's a month. We have to define accounting period because we need to know when we are going to recognize those revenues and expenses. So in the following three transactions, should we recognize revenues in September if we see these transactions? Okay. The first transaction is that what if we receive cash in September for a client that we serve in August? Number two, should we recognize revenue when we receive cash in September for a client who prepay for the class, and the class is going to be held in October? The third one, receive cash in September for a client we serve in September. Okay. Now going back to my previous slides, when do we recognize revenue? When it's earned, right? So if we receive cash in September for a client that we serve in August, we didn't earn the revenue because we didn't provide the service in September. Therefore, we should not be recognizing in the current accounting period, which is September, for revenue because it's already earned in August because the service is provided in August. The second one, did we earn revenue here? The answer is again no, because it is a client who prepaid for class in September. Although we received cash, we didn't provide service, so it's not recognized as a revenue. The third one, do we recognize the revenue for a client that we serve in September when we receive cash? The answer is yes, because we served the client in September. Now you can see it depends on when the transaction happened. I mean, the revenue service is incurred. Your question to yourself to judge whether you should recognize the revenue is that is the service provided in the current accounting period. Okay, so here is the solution. For the first one, we don't recognize revenue. We debit cash, we credit accounts receivable. Because in August, the company must have already debit accounts receivable credit revenue. So if you recognize revenue again, you are you're recognizing the revenue twice. The second one, we don't. We debit cash, we credit unearned revenue. Okay, although it has revenue in it, it's not revenue. Unearned revenue is a liability because the customer deposit money in our company, we didn't provide service yet. Okay, a lot of things fall in this category. For example, if we are a company that sells season tickets for hockey games, okay, that season ticket we sold before we hold any hockey games are also unearned revenues. Okay, unearned revenue will be recognized as revenues whenever the service is provided. So for example, here in October, if half of the service that the customer subscribed is provided, then we recognize half of it as revenue. So let's say it's $100 cash, $100 unearned revenue. In the next month, if the client came in for a class which is $50, we debit $50 of unearned revenue. We credit $50 of revenue. Okay, we transfer unearned revenue to revenue when the service is provided. The last one, if we receive cash in September for a client we serve in September, yes, debit cash, credit revenue. That's pretty straightforward. Next, recognizing expenses. When do we recognize expense? Okay, expenses recognition. So revenue recognition is whenever revenue is earned. Expenses recognition rule is that whenever the expense is matching the revenue. Okay, what does that mean? That means expenses incurred whenever we use the resources to generate the revenue. Now you coming back to a lot of you complain about you don't understand the wording of the exercise and so on. This is actually the wording. The wording says that what is an expense? An expense is the resources that the manager spent to generate the revenue. Okay, so revenue is management generated resources. Expenses are the resources spent to generate the revenue. Okay, so that's what we call matching principle. Matching principle says that you need to match your expenses with the revenue you have earned. Let's take a look at the following example. So again, the accounting period September 2019. Should we recognize expenses in September for the following transactions? Okay, first one, paid cash. Now see, cash is paid in September for supplies that we purchased in August. Do we recognize this as an expense? No, because we didn't use the supplies in this period. We just pay cash for the supplies we purchased before. So we are not using anything to generate revenue, so it's not an expense. We debit accounts payable, credit cash, which means last period in August, that when the company purchased supplies without paying for it, the company debits supplies, credit accounts payable. This period, when they pay for it, we debit accounts payable, credit cash. There's no expenses here. Second one, pay cash in September for insurance that is effective for October to December of 2019. Is that an expense? The answer is no, because this prepaid insurance is not used in September. So when you are generating revenues, your revenue is not based on the insurance based on the protection provided by this particular insurance, because it's not covering September. So when we do accounting records, we debit prepaid insurance expense, we credit cash. Now you'll see expenses in the debit side. It says expense, but it's not an expense. Prepaid expense, it's an asset. Okay, this is just like a prepaid phone card. You have a prepaid phone card, you have prepaid Amazon card, gift card, so on and so forth. You didn't use it, right? If you have the Amazon card, $100, you never use it, you always have the $100 at your expense to be expended. So this is an asset, which means the definition of asset is the resources, or it is the resources that's going to bring us future benefits. This is perfectly matching the asset definition. So prepaid expense is an asset. Okay, again, unearned revenue is not a revenue, it's liability. Prepaid expense, it's not expense, it is asset. Okay. All right. So we debit an asset account, we credit another asset account. So it's all on your left-hand side of the equation. Third, pay cash in September for supplies. Okay, is it an expense? This is one of the situations that most of my students get confused of. Most of them says that I paid for supplies, so I debit expense. No, you don't, because you didn't use the supplies. You are just buying the supplies. So let's say if you have a pen sitting in your drawer for hundreds of years, it never become expensive because you never use it. Okay, if you never use it, it is an asset because it is for your future um, spending. So you are going to debit supplies, credit cash. Again, it's all on your left-hand side of the equation. The last one, if we use up some supplies in September, now there's no cash paying here, but it is an expense because we use up the supplies. Okay, again, it's the same thing. If we haven't used any insurance, it is prepaid insurance. We are using it, we will be debit insurance. So let's say October, right? In October, what you should do is that you need to debit 1/3 of this whatever prepaid insurance you have. Let's say you prepay $90, you debit $90 of insurance expense, you credit, I'm sorry, you debit $30 of it, 1/3, because October, November, December, you use up only 1/3 of it. So you purchase $90, you would debit $30 of, I'm going to write this down. Okay, let's say this is $90 and credit cash $90, right? So this is September that you are recording. In October, it would be debit insurance expense $30 because it's only 1 month out of the 90. You would credit prepaid insurance $30. Okay, what does that mean? That means you are using up 1/3 of your prepaid insurance out of the 90. And if you combine these two in October, you will see that your prepaid insurance account will have only $60 of balances on the debit side. That means that's exactly what it means. It means you have 2 months of insurance left. That's $60 because each month it's $30, right? You have 2 months left, November, December. So in October, your insurance balances will be $60 because you are subtracting the 30 from the 90. Okay, so I'm sorry. So let's sum up what I have just talked about. So we need to first have a time period assumption. In our case, it's 1 month. That's how we record our transaction. That's how we confine our recording. And during the month, we ask ourselves, did we earn revenue by providing service or selling products? right? If we do, we recognize revenue. We don't, it's not revenue. The second question we ask ourselves, we use up resources to generate the revenue. If we did, in the uh, supply example, if we use up the supplies, that means, let's say you use up a pen, you use up the board, you use up a string when you're providing the guitar lessons, that is matching with the money you earn in the month. So if you're using up some of the stuff that some of the resources to generate revenue, then it becomes expense. If you never use it, it never become expense. So revenue and expense recognition, it's a matching principle according to the GAAP, which is the generally accepted accounting principles. You will see that a lot if you are accounting students. Okay, I'm gonna stop my first video here. It's 15 minutes already. And I'm gonna start the adjustment in my next video.